I hate analogs of any type where you compare, this market year looks just like that market year, but there is a very interesting correlation between this play out in the market this year and what's been happening to 1987 when you had the big crash, which came after a correction in the markets. It rallied back to about 2.5% of all-time highs, exactly kind of where we are right now. And then you had the big fall off in 1987. So I don't think that's going to happen, but it is kind of spooky how close it is right now. So we'll keep a real close watch on this. So here's what you need to know before the bell this morning. Great week last week for the markets. We've had just a phenomenal recovery here just over the course of just really 5 days. Came off that Japanese yen carry trade blow up thingy that happened, thingamabobber, and that's led to this fairly strong rally here as a recovery. Now, interestingly enough, there's a big gap right now between the S&P and the Japanese yen. The Japanese yen has actually started to reverse here a bit, and when we saw that happen before, that's what led to this fairly decent correction in the market. So again, right now the markets aren't paying much attention to it, but I don't think that whole issue risk thing is over just yet. So we want to be a little bit cautious about that at the moment. And just ironically, I hate analogs of any type where you compare, this market year looks just like that market year, but there is a very interesting correlation between this play out in the market this year and what's been happening to 1987 when you had the big crash, which came after a correction in the markets. It rallied back to about 2.5% of all-time highs, exactly kind of where we are right now. And then you had the big fall off in 1987. So I don't think that's going to happen. I don't like analogs because there's too many variables at work that can make things turn out differently. But it is kind of spooky how close it is right now. So we'll keep a real close watch on this as we go forward. As I said, of course, keep a watch on interest rates. I think that interest rates can reverse here just a bit and see potentially a bit of a retracement in those rates. We've seen them come down fairly sharply here. They're rebounding here a bit. I think those can move up here again to like 4.1, 4.2. That would not be surprising. That basically just take us back up into resistance of these moving averages, which are now trending lower. And that's why I'm saying, if you take a look at where interest rates are headed, they are trending lower. But we are about to trigger a buy signal on interest rates. So again, that suggests that interest rates are going to move up here. Again, some economic data coming out stronger than expected. Maybe the Fed not as aggressive on cutting rates as everybody was hoping for. There's a lot of things that can happen here over the next couple of weeks that could certainly kind of push these rates back up here a bit. And that'll give you a better opportunity to add, like I said, add fixed income to your portfolio. Outside of that, crude oil also continues to basically just kind of flop around here within a big consolidation range, and that's fine. Again, that hasn't really gone anywhere one way or the other, and there's not a lot of stress right now economically. The one thing though is that these kind of lower oil prices are weighing on the energy sector a bit, but also this is keeping inflation near term under control because there is a high correlation between short-term moves, month-to-month changes of inflationary pressures driven by energy prices. But again, there's oil's just not been doing a whole lot as of late. Volatility, of course, that was the big story just a week ago, had this massive spike in volatility that has been completely erased. We're now running back around 15 on volatility. So again, that whole volatility spike that was a big concern just 2 weeks ago has completely reversed itself. Outside of that, to take a look at international markets as an example, they've been recovering here a bit. But again, you've got to really take this into kind of a longer term view because the short term rally in emerging markets looks great. And it looks like that if you just take a short term look at the chart, it looks like it's been doing just fantastic. Pull this out about 2 years. And again, we take a look at emerging markets. They still even haven't set a new high yet. They've been doing better, but again, they're still below their 2020 peak. International markets, that was international markets. I apologize, I said emerging markets. This is emerging markets. Emerging markets is a very different picture here. Emerging markets haven't done much since the crash in 2020. They've just really gone sideways and have not really done a lot. So again, just outside really of domestic stocks, that's really where most of the returns have been delivered this year. Importantly, mostly in the S&P 500, the NASDAQ, much more so than we're getting out of small and mid-cap stocks, as well as emerging markets and international. So again, just kind of keep that all in place as you kind of look at your asset allocation, because some of these markets are delivering a drag to portfolio performance. And kind of traditional asset allocation says own some of this, own some of that, own some of this other thing. Most of these other markets have been dragging on overall portfolio performance for the last year or so. That's what you need to know before the bell this morning.